Hello, everyone, and welcome to our latest Signature FD investment audiocast, where we break down the key economic indicators, especially from the week prior, and what they might mean for the market. So let's dive right in here. First off, looking at the ISM Manufacturing Index last week, that was a surprise to the upside. And while it remained below 50, which signals contraction, it's not indicating a high risk of a broad economic recession at this point. So the manufacturing PMI, that's one of 10 indicators that's tracked by our friends at Ned Davis Research in their recession watch report. And with the improvement in manufacturing, none of the 10 impactful economic indicators that they follow are currently showing signs of elevated recession risk. Now, moving on to the health of the labor market, the job openings and labor turnover survey, or the JOLTS report from October, that essentially showed a balanced labor market. We saw openings increase while hires decreased slightly, but the key takeaway was that layoffs decreased even more than the hires decreased. Now, businesses are curtailing hiring, but they're also not firing. Additionally, the quit rate ticked higher, which aligns with what we're seeing in consumer sentiment post-election. A higher quit rate is typically indicative of workers that are feeling more confident about finding new jobs. Now, next, the ADP report that showed 146,000 private sector job additions in November. Now, that was slower than economists' estimates, but it's still a very solid number. Now, small businesses are still cutting jobs, but large and medium-sized enterprises are adding. Now, the BLS report on Friday, that showed payrolls expanding by 227,000, which was above expectations. Now, there were also upward revisions to prior months. The unemployment rate did tick higher, though, to 4.2%, but this appears to be due to more new entries into the labor market rather than layoffs. All in all, the jobs picture to us is looking good for now. Wage growth was up 4% in this report, and that's compared to inflation of about 2.5% to 3%. So real wages were going up, and real wage gains are driving continued consumption, and that's creating something of a positive cycle for the economy. So looking ahead to the macro events for this week, CPI, or consumer inflation, that'll be the big one to watch. And we have a labor market picture now that shouldn't dissuade the Fed from cutting interest rates next week, but inflation will tell the rest of the story. So we'll have CPI on Wednesday, producer prices on Thursday, and import prices on Friday. So zooming out to the really big picture for investors, is stocks tend to perform well when growth is stable to higher and inflation is stable to lower. And we're currently in that sweet spot of growth and inflation. However, we do expect a moderation in the bull market trajectory next year. And stocks don't tend to just rise straight up to 8%. Instead, when you have one of those average or below average years of returns, you can expect more volatility. More volatility tend to be associated with those softer years. Big up years like we've had this year and the year prior are often characterized by a lack of volatility, but that's not what we expect in the year ahead. So that's all for now. Thanks for tuning in to our weekly audio cast, and stay tuned for more updates and insights. Until next time, have a great week ahead.